Welcome back to the channel. Thanks for checking out this video. If you can like this video and subscribe to this channel, it will be greatly appreciated. Again, this is Larry Poteat Jr. I'm your financial planning consultant and your real estate agent. Today, we're going to focus on the third aspect of the BSI challenge, which is the budgeting, saving, and investing challenge. So we're going to focus on investing. We already touched on budgeting. We touched on saving. Once we get to the investing portion, we're making assumptions that you can now incorporate some of your savings into a bucket that we call investments. And so when it comes to investments, what I think about is I think about having your money work harder for you than you're working for your money. We all know that it's good to work hard for the money, but at some particular point, we have to make sure that our dollars are working for us and that our dollars aren't just staying stagnant. And so just think about it. And I'm going to talk about a couple of concepts in this particular video. When we think about putting our money into savings, we know when we think about our interest rates or our rate of return when it comes to savings, when we think about our savings account, I hear a lot of people saying, man, I have $500, I have $5,000, $50,000, $100,000 in my bank account, but I only got 5 cents in interest or 10 cents in interest. That's because when you think about your savings accounts, a lot of times you barely have 1% interest. So you're not making any money off of your money. And so investing means that you're going to put your money in the best situation as possible to make more money for yourself. And so, like I said, it's great to work hard for the money, but let them dollars go to work as well. And so one concept that I'm going to speak on is the rule of 72. Basically states that whatever interest rate that you're getting on your money, if you divide that rate into 72, that's how long it will take for your money to double. Here's an example. Let's take 1%. When you look at your savings account, let's say if it's 1% interest. So if you divide 1 into 72, that will be 72. So that means it will take whatever money that you have in that account, it will take 72 years for your money to double. I don't know about you, but I don't have 72 years for my money to double. I'm 43 years old. You add that to 72, that's definitely not going to work. That's 115 years. That's not going to work for me. And so what we're going to do is we need to find a better route to make sure that our money is growing faster than 72 years. And so when you think about the stock market, a lot of people have fears and anxiety when it comes to the stock market. But on average, the rate of return of the stock market is 12%. Yes, we see the stock market go up and down. When it comes to the media, a lot of the focus tends to be on the negative side. So a lot of times you hear when the stock market is down, you hear when the numbers are red, you hear when stocks are at all-time lows. But like I said, on average, the average rate of return is 12% with the stock market. So let's take 12. If we take 12 and put that into 72, that will be 6. So that means your money can double in 6 years. Like I said, I don't know about you, but 6 sounds a lot better than 72. Investing is nothing to shy away from, but it's also about making sure that you have enough information to make an informative decision. And so that's the thing about investing, or that's the thing about the stock market. It's all about making sure that you have as much information as possible to make the best decision as possible. So another concept is dollar cost averaging. And this is something that I recommend. When we talk about our budget and we talk about saving, I'm all about consistency. That is my word for this year, being consistent. And so that's what it's about when it comes to saving. That's what it's about when it comes to investing. Save consistently, invest consistently. So just like saving, when you invest, you're going to put a dedicated amount aside every single month. And so that's what dollar cost averaging is. So whether the market is up or whether the market is down, if you consistently invest, you will always make out or you will always win when it comes to the stock market. Because when it comes to the stock market, it's not about timing the stock market. A lot of times people try to figure out, am I at the bottom? I want to jump in the market now because it's at the bottom. But the reality is the stock market may be on the top. You don't know when the stock market is up or down. You can't predict when the stock market is going up and down. So it's not about timing the market. It's about your time in the market. So that's why consistency pays off. So if you're consistently investing $500, $5, $50, what happens is this particular month, the stock market may be down. You're able to buy more shares because the share price is down, and your $50, $500, $5,000 is able to go a lot further. Next month, the stock market may be up, so your $5,000, $50 may not go as far, but you're still consistently buying. And so over time, that will average out. And with a 12% average on a yearly basis, your account is going to be multiplying. So that's what it's all about. It's about making sure that you're saving consistently and that you're investing consistently. Another thing about investing is about ownership. And that's why I love investing. So when you invest in stocks and you invest in mutual funds, you're actually owning a fund, owning a company, owning a corporation. And so in these videos, you hear me mention a lot about making target runs. Target is in the stock market. That company, you can actually buy a share of that. So not only are you just buying a stock, but it has meaning behind it. You're actually, when you buy a stock, you're actually buying ownership in that particular company. It may be a small, teeny fraction of that company, but you're still an owner in that corporation, which is huge. And so when you think about everything goes back to the budget. So when you think about making target runs, going to McDonald's, going and buying gas, sometimes instead of making those runs, save that money and invest in that company. Sometimes when you're thinking about making that target run or thinking about going to McDonald's, going to buy gas, whatever you're going to spend your money on or purchase, think about investing in a particular company. Same thing with coffee runs. You can buy Starbucks. Instead of buying a coffee on this particular day, how about buying a share of Starbucks? In return, ownership in that company will pay in the end. It will pay in appreciation. And then also a company like Starbucks, a company like McDonald's, a company like Target, they actually give their owners a dividend, which is a payment for the owners of that particular company. Think about real estate, and if you own a property and the renter pays you the rent, that's what a dividend is. It's a payment to the owner. And so in this case, if you own a share of Starbucks, they will pay you a dividend. They will make a payment to you. So you can either take that payment, put that in the bank, or you can take that payment and allow them to buy you another share. And so what that means is your portfolio will grow over time, but also your monthly amount will grow as they are paying you sometimes on a monthly basis, on a quarterly basis, or on a yearly basis. It depends on what stock or what mutual fund that you're investing in. So when you go through this challenge, it's not just about putting your budget down on paper. It's not just about saving. It's about putting a financial plan or a system in place. It's about making sure that you have a handle and you can track what's coming inside of your house for what's going outside of your house. It's making sure that you're able to save, making sure that you have an emergency fund set aside. So if something happens to your car, something happens medically, something happens to your house, you're sufficient and things are taken care of. When it comes to investing, making sure that you're consistently investing so that you can retire in the future, so that you can go on vacation, so that you can buy a car, buy a house, so that you have another stream of income. That's what that's about. But also it's about legacy. It's about taking ownership of a company, a corporation, buying into that. So you can leave that to another generation, or you can own it for yourself. Everything is about assets, additional income, another stream of income. That's what it's all about. So thank you guys for rocking out with me and staying on this journey. Remember, it's all about being disciplined and being consistent. I hope you guys have a blessed day. Look forward to hearing from you. God bless.